Will your retirement accounts survive the next downturn? This is Rich from richandmoney.com, and today I'm talking to you about how to survive a huge downturn in the market. Is that downturn next week or next year? Your retirement accounts need to last you the rest of your life. They might, but you could get screwed by a big drop in the market at the exact wrong time in your financial life. I'm going to share with you 2 ways to protect yourself from a sudden downturn in the market. Number 1 is gradually lower the volatility in your retirement accounts, and I'll show you exactly how to do that. Number 2 is adjust your withdrawals in retirement based on market conditions. This might sound a little complicated. I'm going to make it simple and straightforward. Let's go. Number 1 is lowering the volatility in your account as you approach retirement. Now, most people, including me, invest in 100% stocks. And by stocks, I mean mutual funds or ETFs or actual individual stocks, but you're invested in the market. How do you protect yourself? We often don't have any fixed income in our retirement accounts. And by fixed income, I mean things like bonds and treasuries. Essentially, these are things that you invest in that will pay a steady amount of money instead of going up and down with the market. An example of this would be you buy a bond and it pays you 2% a year no matter what happens. Market goes up a lot, market goes down a lot, doesn't matter. You get 2% a year. That's what fixed income is. Examples of fixed income in the military TSP account would be the G or the F fund. Now, examples of what are stocks are the C, S, and I fund. Now, while your portfolio has the ability to grow faster if it's invested in 100% stocks, it also has the ability to drop much faster in a downturn. This is particularly important around the time that you begin withdrawing from your retirement accounts. And this is why it's important to put a certain percentage of your portfolio in the fixed income we're talking about to lessen that volatility during huge drops like that. If the stock market dropped 50% and you were 100% invested in stocks, then you would also drop 50%. But if you have a certain percentage in bonds, that 50% drop would be reduced by the amount you have in bonds. Basically, you're lessening how much you would lose in a catastrophic event. Now, there's a flip side to this. If the market goes up 50% and you have money in bonds, you would go up proportionally less as well. So there's that trade-off. But there is a way to balance the right amount of stocks and bonds so that you shave off some of that crazy volatility that you can't afford as you approach retirement. Let me introduce you to the law of 100. With the law of 100, you subtract your age from 100, and that should tell you the percentage of your account that should still be in stocks. A 30-year-old would have 100 minus 30. He should be 70% invested in stocks. This is a very old rule. People are living longer now, and we need our retirement money to last longer. So that rule of 100 has been bumped up a bit, and now financial advisors are advising to use the number 110 or 120 and subtract your age from that. I recommend choosing one of these 3 numbers between 100, 110, and 120 based on your situation and what you perceive your risk tolerance is. Ask yourself these questions. Do I have a higher or lower risk tolerance than other people in my age group? Is my only source of income retirement, or do I have other things like a pension or real estate or both? For me, as a retired military member with a pension, I'm comfortable using 120, and I'm going to call 100 conservative and 120 aggressive. You make that decision for yourself. So I'll take my age and subtract it from 120, and that will let me know what percentage of my portfolio should be in stocks. The rest should all be in bonds. I can do that in my IRA or 401k or TSP. I can make those adjustments in my account without creating a taxable event. Do this every year on your birthday. Make a slight adjustment to your portfolio based on this rule. A certain percentage of stocks and a certain percentage of bonds. Maybe you've heard of target date funds, or if you're military, you've heard of the life cycle funds or L funds. What I'm showing you right now is what these target date funds or life cycle funds do. They gradually adjust to a more conservative portfolio as you get closer to the age that you need to retire. You're just doing it manually. You're controlling it, and you know what's going on with your money. This is how you use fixed income to help lower the volatility in your retirement accounts. And if you're a military or federal employee, you can do this with the F or the G fund. That should balance out your C, S, and I funds. And for everybody else, you can easily buy fixed income, treasuries, bonds, bond funds at pretty much any financial institution. I tend to recommend Vanguard, Fidelity, and Schwab as the best places to invest. Just make sure they have low fees. So that is the first part of protecting yourself from a downturn in the market. But there's a second really important part, and that is making sure that you adjust your withdrawals based on what's happening in the market. To know how to do this, you're going to have to understand what sequence of returns risk is. Sequence of return risk can either help you or hurt you depending on when it happens. It can mean the difference between running out of money halfway through retirement or ending up with 8 times the amount of money you started with. If you understand it, you can adjust your withdrawals based on which one of these is happening to you. Now here's the trick. During the years you're withdrawing from your retirement, if a large amount of negative returns years happens right at the beginning, that can really screw up the nest egg that needs to last you the rest of your life. And the opposite is also true. If at the beginning you get a lot of up years, you're very likely to end up with a lot more money than you need. How long a portfolio lasts depends a lot on the sequence of returns at the beginning of your retirement. Now let me clarify this for you. Sequence of returns only matters when you're withdrawing money. And I'm going to show you exactly what I mean. I'm going to give you a fictional scenario between Mr. Green and Mr. Brown. Both have $1 million in their account and it grows on average 6% per year over the next 25 years. Now in one scenario, a string of poor returns happens right at the beginning. And in the other scenario, a string of large up years happens right at the beginning. If you're not withdrawing money from your accounts, the order that these returns occur in has no bearing on how much money you make in the end. You just end up making the average 6% returns. You can see here Mr. Green starts with 3 good years and Mr. Brown with 3 bad years. The sequence of investment returns has no bearing on the portfolio value at the end. This is because no money was being taken out of the account while it compounded and grew. Looks like they both end up with the exact same amount of money, more than $4 million. Hell yeah. Only the average annual rate of return matters at this point. The order that it happened in didn't matter at all. Let's see what happens in the same scenario when Mr. Green and Mr. Brown start taking 5% withdrawals. That's 5% of the total each year for that 25 years. Mr. Green starts these withdrawals in an up market. Unfortunately for Mr. Brown, he starts his withdrawals in a down market and runs out of money before the 25-year point. Mr. Green ends up with 2.5 times the money he started with, even though he's taking out 5% for 25 years. This is vastly aided by having those up years in the beginning. That's sequence of returns risk at work. Mr. Brown got screwed by the sequence of returns. By having those bad years at the beginning, it set him up for a small enough portfolio that once growth happened, couldn't save him. How can we avoid these two extreme scenarios? One where you run out of money, one where you could have spent more money. I'll show you. So according to the Trinity study, if you have $1 million, it is very safe to withdraw 4% a year for the rest of your life. There's a caveat. Sequence of returns risk is what can screw this up. Let's first talk about how to avoid running out of money. That's the most important one. If at the beginning of withdrawing your money in retirement, there happens to be significant down years, you need to adjust how you're withdrawing. Withdrawing 4% a year could screw you up. At a minimum, you're going to move that down to 3%. Ideally, you're going to find ways to not withdraw too much during these down years. How can you do this? Well, maybe you have taxable investments that you can sell. Maybe you can work longer. Maybe you can do a side hustle, side job, part-time job. Just avoid taking out too much money at the beginning if that happens to be a bear market or you're just seeing a lot of negative return years. 3% or less. The less the better. Now, when you get to the point where you see your second up year, go ahead and return to the 4% rule. Now that we're back on track again, we're going to worry about when you can actually increase your spending. How to avoid underspending, the ratcheting method. I'm going to put a link in the notes to where this information comes from. It comes from Michael Kitcey's blog post on sequence of returns risk. A simple way to determine if you can spend more money is you can increase your spending by 10% once you've seen your initial balance grow by 50%. So if your initial balance in your account was $1 million, once it reaches $1,500,000, you increase your spending by 10%. If you're spending $40,000 a year, now you increase that number by 10%. Now the rule resets. You have a new initial balance, $1,500,000. Once that new balance of $1,500,000 has increased by 50%, you ratchet up again by 10%. Here's a catch. You can't ratchet up too fast. The rule is only one up ratchet every 3 years. That'll keep you from ratcheting up too fast in a really fast-growing market. So let me summarize this a little. If the market goes down at the beginning, then you decrease your spending. If the market takes off in the beginning, then you ratchet up using the rule I just gave you. 50% growth for a 10% increase in spending. This ratcheting up will allow you to take advantage of the magic of sequence of returns risk when it's working for you. I have a chart here that shows over 3 different time periods how the ratcheting rule would have been applied in those scenarios. And you'll see how often you were able to ratchet up, or if you're able to ratchet up at all. Those time frames are 1966, 73, and 82. In each case, the 25-year time frame starts on that year. As you can see in 1966, because of poor returns at the beginning, no ratcheting occurs. However, the 4% rule ended up lasting this person's entire retirement years. In 1973, there wasn't a ratcheting indicated until halfway through this chart. And then there was finally enough of an increase. After that, it was able to happen 3 more times. In 1982, we ran into one of the most favorable sequence of returns risk time periods. The ratcheting up in spending occurred on 9 different occasions. If you do the math, that worked out pretty damn well. Ratcheting up ends up occurring in most time frames studied, and in most cases, it ends up being more than once. It is far more likely to need to use ratcheting than it is to need to cut your spending at the beginning. But if you just happen to be that unlucky person, be prepared to cut back. In summary, there are 2 things you need to do to make sure that your money lasts as long as you do, to make sure that you can beat a huge market downturn. Number 1 is make sure you gradually shift your portfolio to a heavier mix of fixed income, treasuries and bonds, as you approach withdrawing. And number 2, adjusting your withdrawal rate based on the sequence of returns at the beginning. And I'll classify at the beginning as the first 5 years. Now you know how to protect your nest egg. Let me know in the comments down below what number you would pick for yourself and what you plan to do with fixed income in your investments. I hope this was helpful today. If so, hit subscribe, hit that bell for notifications, give me a thumbs up. Check out these other videos of mine that you can watch. This is good stuff. This guy really knows what he's doing. This is Rich on Money, signing off.